Assalamu alaikum friends, welcome to question number 55 from your SBR revision kit Kaplan. This question is one before the last question. Okay, after this we just have one last question and we are done with the revision kit. That is your question 56. Lucky. So let's see what do we have in this question. In part A, if you read the requirements for 8 marks, the directors of Artwright require advice about the above events are accounted for in accordance with IFRS. So we don't know what is the above event about, right? Because sometimes when you just read the requirements, it's not clear from the requirements what is the specific event about. It's okay. At least you can, when you're skimming, okay, there will be some word which will help you, some word that triggers that this might be the thing. It would be an intangible asset, it will be a financial instrument, or it will be deferred tax, something like that. Something will be there, right? So looks like that this has something to do with intangible assets because they are talking about they are in the chemical industry. Okay, so chemical industry means they'll be having research and development cost. So mostly it looks like it's an intangible asset. IS 38 needs to be applied, but we'll see whether we have some other standards also or not. Coming to part B. Part B, I don't even have to read the requirements. Okay, why? Because this word says derivative contract gives me an idea of what the standard is all about, right? It is about your IFRS 9 and we have fair value also. So if you read, it's very clear, even from your requirements also. Assume that all designated hedges meets the effectiveness criteria outlined in IFRS 9. Okay, what is this effectiveness criteria? It's given in your IFRS 9. Go through it. If you remember, if you forgot what are the hedges or derivative contract, you need to go back. I have a separate video under my SBR lecture just for this derivative contract because IFRS 9 I have divided it into 10 parts. There are 10 videos on it. So it becomes easy for the ones who searches for things like particular things like per financial asset or whether it's a financial liability or it's a derivative. It's very easy because I have kept it in a separate video. There's a 10 parts to it. So somewhere I don't remember the exact number, but one of it is on derivative contract. So there you will get this effectiveness criteria. I think it's towards the end. This topic is touched towards the end in your IFRS 9, right? So go back and revise it. It's for 9 marks. You need to do a lot of working here. Directors would like an outline of the hedge effectiveness criteria. What is this? You need to outline it. And also require advice on how the three derivatives should be accounted for. Okay. One, outline hedging effectiveness criteria. The other requirement is for the three derivatives, how it should be accounted. Derivative A, B, and C. It's quite a lot of work. And then part C for 8 marks. If you read part C, you can see you are given exchange rate. Definitely you have to convert something. Exchange, gain, loss, something, and then how you are going to deal with it. That's the requirement all about. The directors request advice on how to account for the loan and the interest in the financial statements. Okay. You can do this in any order. These three requirements, you can do it in any order. Okay. It does not matter. Let's start with A. They trade in the chemical industry. Entity has development and production operations in various countries. It has entered into an agreement with Joe Master under which Artwright will license Joe Master's know-how and technology. Okay, to manufacture a chemical compound. That is Volt. The know-how and technology has a fair value of 4 million. Okay. Artwright cannot use the know-how and technology for manufacturing any other component than this one. You cannot use it. You can only use it for specific purpose. Okay. You cannot use it for manufacturing. Artwright has not concluded that economic benefits are likely to flow from this compound. They have not concluded that any economic benefits is likely to come from this compound, but will use their technology for a period of 3 years. Artwright will have to keep updating the technology in accordance with their Geomaster's requirement. Update the technology in Geomaster requirement. The agreement stipulates that Artwright will make a non-refundable payment of 4 million to Geomaster for access to the technology. What does the agreement says? They will make a non-refundable payment of 4 million for access to the technology. It will not be refunded back. Okay, if you want to get access to the technology, pay 4 million. Additionally, Geomaster will also receive a 10% royalty from sales of the chemical compound. Okay. Additionally, Artwright is interested in other component, that is Yakton. Yakton is another component which is being developed by Geomaster. The compound is in the second phase of development. The intellectual property of compound Yakton has been put into newly formed shell company Conio, which has no employees. The compound is only asset of Conio. Okay. Artwright is intending to acquire 65% interest in Conio, which will give its control over the entity and compound. Definitely 65% more than 50 means it will have a control. Artwright will provide the necessary resources to develop the compound. Now, how these events will be accounted for? There are two events. One is for the first component, that is what is it? Wallet, or whatever, and the second component is Yakton. So there are two components, and you need to talk about those two components, how you are going to account for it. And definitely the standards will be different for the two things. It's for 8 marks, so for 4 marks each. 4 marks for component 1, 4 marks for component 2. So yes, as I was predicting, it is intangible asset. Because words like intellectual property, research, development, technology, something which is going to be used later, license, know-how, you are giving license for know-how, technology, these are the trigger words for you to identify that it's an intangible asset. Okay, so IS 38, you start with the recognition. How do you start this answer? With the recognition step. As I have always told you, that always start with the recognition under a specific standard. You build your answer with recognition. Okay, so that means how do you recognize intangible asset if certain criteria are met? What are the two criteria? This one and this one. One, there's a probable that economic will flow to the entity from using that asset. Second, cost you can measure reliably. If these two conditions are satisfied, you recognize an intangible asset. Okay, so that will give you 1 mark out of 8. But remember, this requirement applies whether an intangible asset is acquired externally or generated internally. Always, whenever we are talking about intangible asset, you have to specify this, whether it is you are acquiring it externally from someone else, another firm, or you have generated the intangible asset internally. For example, uh, your business is a brand now. You have created a brand. That is something that you have internally generated. You cannot recognize it in the financial statements. But if you have got it from someone else, you bought it, right? Externally you have acquired, you can recognize it. Okay, so make sure that you mention about this also in your answer. Now we are moving to what? We have to see whether you can recognize it or not based on this two, first and two. First one is probability, second one is the cost. So this talks about the recognition. Now you are linking it to the case study, the recognition step for intangible asset. Because recognizing intangible asset is an area which examiner often asks, because it's a tough area. It's tough to decide whether you are going to recognize it or not. Remember, under intangible asset, most two areas usually examiner ask. I'm not saying these are the only questions. There might be other questions also. But the two common questions are, one is recognition, whether you recognize it or not, and second is impairment of intangible asset. Okay, but impairment thing is easier because it is common for other assets the way you impair, same for intangible asset. There's no difference. The only difference is in the recognition step. So the probability of future economic benefit, because this benefit of knowing how and technology, you are going to get it in the future, something for the future. Currently, you are not having any benefit out of it. So the probability of future economic benefits must be based on reasonable and supportable assumptions. Assumption should be supportable as well as it has to be reasonable about conditions which exist over the life of the asset. Okay. So the price of an entity, price an entity pays to acquire that intangible asset. You are paying a price to get an intangible asset. That reflects expectations about the probability. What is the probability that you are going to get some benefit? Benefit will flow to the entity. Because when you pay, you get the intangible asset and you get the benefit. Entity is going to receive. Economic benefits flow. Understanding? So what does this mean? This means that the effect of probability is reflected in the cost of the asset. Okay? Because there's a probability that is already reflected in the cost of the asset. And so the probability recognition criteria is always considered to be satisfied for intangible assets that are acquired separately or in a business combination, remember. What does it mean? Another 1 mark for this, by the way. It's 1 mark. It means that when you are buying something, acquiring separately or in a business combination, it comes as in a business when you're acquiring a subsidiary, with that subsidiary comes intangible assets. That way also, or separately, just the intangible asset you are acquiring externally, okay, you are always going to recognize it. It's always going to satisfy the recognition criteria for intangible assets from the point of probability recognition. We are not talking about the cost, whether we can measure it or not, but from the point of probability, yes. Why? Because there will be cost, no? You will know the cost, that this is the amount that I have to pay to get this asset. So in that cost already they have reflected the effect of probability. Understood? So you pay, you get it, and benefit comes to you. So that's why you are going to recognize it in these two conditions, either acquiring separately or in a business combinations. Okay? Now, so in this case, what happened? Mention the name of the company. This is how you link to the company. They should recognize or they should not recognize. You immediately start talking about it. They should recognize an intangible asset for the use of the geomasters technology. Definitely, because they are going to use it for 3 years. For that 3 years, they have to recognize this intangible asset. And they told the cost also. The fair value is 4 million. So this right should be measured at this cost of 4 million. Mention the cost if you are given the cost. Okay? And remember, when intangible asset you recognize, what's the next process? What's the next process? If it's tangible asset, depreciation comes. Same way, for intangible asset comes amortization. So don't forget that. You need to amortize. Intangible asset should be amortized from the date it is available to use. From the day it is available for use, that intangible asset, from that day onwards you have to start amortizing it. Not before that. Not after that also. You need to know the exact point when you are going to amortize from which date. And this technology is available for use. We are talking about technology, okay? This technology is available for use when the manufacturing of the component begins. So at the end of each reporting period, what do? You have to check impairment. Same like tangible, intangible asset also, you have to review annually at the end of each financial reporting year whether impairment is there or not, whether there is an indication that asset is impaired or not, because your technology also can get impaired. It might become obsolete, out of date. You have to always keep checking on it, especially because it's technology. You have to be checking it more frequently, because technology gets impaired at a very high pace compared to other assets. Okay, so you have to check for the impairment also. Another 1 mark. Okay, another 1 mark. Talking about amortization impairment. Next. So you see, out of 8, 4 marks only for this one. Intangible asset. According to the first component is intangible asset. So due to the nature of intangible asset, subsequent expenditure will rarely meet the criteria for recognizing the carrying amount of an asset. Because of the nature of intangible asset, whatever the expenses are there will rarely meet the criteria for being recognized in the carrying amount of an asset. Understood? What does it mean? What does it mean? In other words, you cannot capitalize subsequent expenditure because the nature of intangible asset is such that it's hard to capitalize. You have to see whether it meets certain criteria or not. Research cost, you anyway cannot capitalize it. It's always expense. But development expenditure, you have to check for the criteria. If certain criteria is either you capitalize, otherwise take it as an expense. That's why all subsequent expenditure you cannot capitalize it. Okay? It needs to meet the criteria. And rarely they meet the criteria for being capitalized. That's an issue. Because the nature of intangible asset is such. So because of that, Artwright continues to expense its own internal development expenditure. They have incurred some development expenditure, so they expense their own internal development expenditure when until the criteria for capitalization are met. I think there are 5 or 6 criteria that you need to meet. I don't remember the list, but go back and check that it has to be feasible, it has to be available for use. uh, I think there are many more. Okay, and you don't have to list all the criteria, by the way, it's not required. No. Okay, so until the criteria are met, expense. And economic benefits expected from capital. Okay, when the drug is sold, they have mentioned a royalty payment. What about that royalty payment? Each and everything you have to write in your answer if they are mentioned in the case study. When drug is sold, royalty payments are presented in profit and loss. Expense, no? How can you capitalize royalty payment and say that is an intangible asset? It's an expense, so it goes in profit and loss. Coming to the second component, which comes under business combination, does it? We have to check. But the second paragraph is subheading is business combination. And under this also we have 4 points, 4 paragraphs. That means 4 points. One for this, one for this. Each point will give you 1 paragraph. Each one for this, one for this. That's how you're going to get the 8 marks. I'm going a little bit slow here because this is a critical area. It's a challenging area. Especially for the first time students who are going to do this, it's difficult to understand things. Okay? Whenever they talk about that he is having a control, or whether it's a business combination or not, or whether they have just bought an asset. Okay, first standard you need to apply is IFRS 10. Before business combination comes IFRS 10, remember. Why IFRS 10? See, don't get confused with IFRS 3 and IFRS 10. They are two separate standards, look similar, but they are different. Okay, IFRS 10. Okay, IFRS 10 only talks about subsidiary. Why? Consolidated financial statements, and you only consolidate when it's a subsidiary. Remember, you only consolidate when it's a subsidiary. So IFRS 10 only talks about subsidiary. That means they will only talk about control. That means definition of control, what gives you control will be explained in IFRS 10. And rest other, whether it's a subsidiary or not, joint venture, whatever it is. When you have acquired something, associate, joint venture, subsidiary, financial asset in another company, goes on IFRS 3. IFRS 3 says whether you are buying a business or just separately an asset. IFRS 3 is for that. But for control and all, if you want to get the definition, take from IFRS 10. So start with IFRS 10 first and then we'll go to IFRS 3. This is the pattern normally that is followed, and I would advise you to follow this pattern. And not to get confused between these two standards. They are two separate standards. Look similar. Okay. So IFRS 10, in IFRS 10, if you go, it's a small standard. IFRS 10 is a small standard. IFRS 3 is a very big, vast standard because it's group accounting. So definitely this two will come. But mostly it is IFRS 3 which comes. IFRS 10 says it gives you the definition of control. What is it? Investor controls an investee when the investor is exposed, has raised variable returns from its involvement with the investee, and has the ability to affect those returns to its power over the investee. Okay. Investor is having a control over the investments. They have an ability to direct. They have an ability to affect the returns that they are getting from their involvement with the investor. There is a meaning of control. Okay. So exact definition as it is, you can take it. So in this case, you have to see whether the company who is taking over another company, are they having a control or not? So in this case, Artwright will control Conio because 65%. And also maybe other facts are given to you to say that control is there. Next, 1 mark. Why? Because you have said at the end, Artwright will control Conio. See, this answer, first paragraph only I'm talking about under business combination. Let's not go to second paragraph yet. Common mistakes done by students. What do they write? Artwright controls Conio because 65%. They hold 65%, more than 50%. So they control, it's a subsidiary, they should consolidate. That's it. No, you will not get messed like this. Just by saying, even though 65% is there, it's okay, it's correct answer, you will not get marks if you write they will control because 65%. See how they arrive to this answer. Artwright will control Conio is in the last line of that paragraph. That means they have derived from here. You have to come down from here. Main point is definition of control. And does this company meet the definition of control? Yes. According to IFRS 10. You have to come like this only. You cannot jump to the exact answer. That Artwright will control or Artwright will not control. Some of you just write in one line only, 2 or 3 words. Artwright will control Conio, Artwright does not control Conio because of so. It's not enough. This is what I wanted to show you. You need the technical knowledge to support your answer. Even if they control or not, it's okay. But you need technical support. From where you will get it? From the knowledge of IFRS 10. This is a technical area. Likewise, for every question, same thing. It's the same. Every paragraph, if you see some standard, they are mentioning about. For example, in second also IFRS 3. Third paragraph also IFRS 3. They are giving some technical knowledge and then they are saying, this is this. Even here also IS 38. Every paragraph is mentioning some standard. From there you are taking the knowledge. So now let us go to the second paragraph. This is small. Any transaction in which an entity obtains control of one or more business. Remember, you are obtaining control, okay. But if it's a business, it could be one business, it could be more than one business. You're obtaining control. It qualifies as a business combination. Now you are giving a definition of business combination. Okay. And if it meets the definition of business combination, it is subject to the measurement and the recognition requirements according to IFRS 3. Mention the standard. Even though you are not writing this business combination, it's okay. You're not writing the name of the standard, it's still fine. But at least write the IFRS 3. Or in case you forgot the number, okay, you can write it like this. According to the standard on business combination, according to the standard for business combination, as per the standard or as per the business combination standard, this is how the rule is. You can write it like that also. It's fine. This second method, which I have just mentioned, you have to apply when you forgot the number. But forgetting numbers is a very rare case. Usually students don't forget numbers because they have prepared that multiple times, right? And another question, some of you ask me that how do I memorize this number and how do I know that this is the standard, this is the standard without looking over? Quickly, how do I identify? Well, for that, what I would suggest is make a list. For example, mm, write it in order. Just see whether it works for you or not. IFRS 1, 2, then we don't have IFRS 4, right? IFRS 3, IFRS 5. We don't have IFRS 6, IFRS 7. So likewise, you write it and then next to it, you write the name. Go through it over and over again every day. Just spend 5 minutes. Just 5 minutes is enough. Okay. It could be at any time when you are free, relaxed. Spend 5 minutes every day. Keep revising a few standards, not all the standards. Maybe every day you can take 5 standards, right? Or 6 to 7 standards per day and you're going to memorize it. Until there comes a day that you are telling someone to test you. You can ask your friend or someone at home that please test me. They will be telling you the name and you have to give the number, or they will be asking you the number and you have to give the name. For example, if I ask you IFRS 5, what is it? Then you will be giving the name. Or IFRS 7, what is it about? Financial instrument. uh, Disclosure. Exactly. Disclosure, not presentation. Presentation is IS 32. So likewise, you have to test. Okay, this is how it's a good way to memorize. But anyway, when you're doing questions, lots of questions, anyway, these things will be there. But this is the best technique to do. Every day, 5 minutes is enough, more than enough. You don't have to sit hours and hours to memorize this. It will not take so much of time also. Trust me, it's very easy. You read it, you repeat every day, 2 3 times per standard you go. It will automatically be there. You will remember it when you go to the exam hall. You will not forget. And at the end, keep the whole list, all the standards in one page together, and then test one by one. You should immediately, just immediately know that the standard is this. That should come. You should until you don't reach, you have to keep practicing this. You have to memorize the standard and all. Because in the exam you cannot sit and wait, okay, which standard is that? Then you will sit, try to identify the correct number. After identifying correct number, then you will start and then you will be writing. It will waste a lot of time. A word is given in the scenario or case study, immediately you have to pick that this is the standard and the rule. Okay, so now link that. We told that this is business combination. Now what is business according to IFRS 3? Further we are breaking it down. You see, as you go down, we are breaking it down until we come to a conclusion. So business is an integrated set of activity. This word is very important. Integrated set of activity. An asset that is capable of being conducted and managed to produce returns. Another important word is a business will have these two things: input and process. Okay, and when you're applying, when this process is applied to the input, it will create output. Remember, business should have input and process. These two things has to be there. So one is integrated, one is input and process. What are process? Processes are included in the acquired group when the intellectual property, that is IP, is accompanied by other resources such as assets or employees, or other elements such as protocols and plans which will further help develop the IP to the next phase. Remember, intellectual property alone cannot give you any return. Can it? But if you are using it with the asset or the employees are using it, then yes, it will give you some benefit, some return. So you're using it, it's like a process. Okay, your assets, your employees, they are your inputs. To that you are applying intellectual property, that is the process, and it is creating an outcome, an output. What is it? You are developing to the next phase, because IP will help you to go to the next phase. IP is like a process in this case. Now, so we have to see whether it meets the definition or not. What the company meets the definition or not at the end. Kono does not meet the definition of a business. Why? It has only one input and no process. It should have both input and process, not input or process. If it has input, no process, it's not a business. If it does not have an input but it has a process, which is very rare, again it's not a business. Both input and process should be there, both. And so it has an input, only one, but no process. That's why it does not meet a definition of a business. Okay, and because of this, is input and process are not available. Just having an input will not be able, through that you cannot produce a return. You need some process to that input. So because there is no process, you cannot create a return. This means that accusation of an interest in this one should be accounted for as an asset accusation. Asset, it's an asset accusation or a business. In accordance with which standard? IS 38, intangible asset. You should know when it's an asset accusation, which type of asset it is. Under SBR, we have studied so many assets: lease asset, financial asset, deferred tax asset, pension asset, tangible asset, financial asset. Which asset is this? Mostly they will give you intangible or property, plant and equipment, IS 16, or investment property also. So out of this only, mostly it is IS 16 or IS 38, okay, which they usually they give. They will not make it so complicated that all the things they will give in one question only. No. So telling that much is enough, that it does not meet definition of business and it meets the definition of an asset. Let us just quickly go through it again in the last few lines just to see. You see, they have no employees. They need some employee to make use of that intellectual property. And component is the oldie asset. So this oldie asset is one input, but there's no process to that input. You need employees to run that asset. You need some process to convert that asset, and through which you can earn return. There is no process. They didn't mention any process. That's why this 65% interest in Cannu is not a business combination. It's an asset. It's possible that most of the students, what they think, the moment this is 65% they have acquired in this company, it's a business combination. No, it did not be. It could be an asset accusation also. Okay, you have to look for the facts. Now, hedge effectiveness. Pay very careful attention to this, because this question I don't think I have done in the previous questions. I think this question I'm touching it this part for the first time in this question. So yes. Okay. So now it's up to you. You can write one by one derivative. Okay, but before that, the requirement asked outline the hedge effectiveness criteria. So first you have to talk about that, then A, then B, then C. Okay. If you see, initial recognition is nil, fair value is 20 million, which is liability. We'll read the details of A. Artwright believes that oil prices are due to rise in future, so during the year has entered into a future contract to buy oil at a fixed price. Artwright has no exposure to oil price in the course of his business. In fact, oil prices have fallen, resulting in the loss of the year, and rather than rising, it fell down. Okay, we don't want to read for B and C right now, because individually you can answer. A, B, C are not related to each other. But let's see how the answer is set up. Before coming to derivatives A, B, and C, first star your answer with hedge effectiveness is written in bold already, as it is from the textbook. If you see, I've covered this in my lectures also. But most of you who didn't see my lecture, or didn't attend my lecture, or didn't go through your textbook relating to this part, because it looks a bit confusing, I will explain you again. It's okay. I will take some time, and again I will explain these things, because these wordings are a little bit, I can understand. It's not very straightforward, because everything is hedging instrument, hedging item, everything looks similar. So it could be confusing. Okay, so if an entity chooses to hedge account, then it must assess at inception and each reporting date and at each reporting date whether hedge effectiveness criteria have been met. Okay, every reporting period they have to see whether these criteria are met or not at each reporting date. That means every year. Okay, what are these criteria? This is a knowledge part. You can easily get score marks here if you know it from your IFRS 9, because you're not applying anything to the case study. Case study, your application comes in derivative A, B, and C. Okay, so that's a good thing in SBR. That's some marks is for your knowledge and some mark is for your application. Now exactly if you tell me how many marks to tell you exactly, I will not be able to tell you that. It's not possible to pinpoint. Maybe you can do it on your own and check, go through one paper and see how much is for knowledge and how much is for application skill. But both is required. Okay, there will be questions which is very easy, straightforward like this also. For example, effectiveness criteria. So these are the three criteria. What is it? First, there is an economic relationship between hedged item and the hedging instrument. You cannot hedge when there is no relationship. There should be some economic relationship between an hedged item and the hedging instrument. What is hedged item and hedging instrument? If I ask you, we have in my AFM lecture, okay, for the ones who have done AFM or who is going to do AFM, they know this hedging instrument, right? We have so many hedging instruments. What are the like derivatives and all we have to hedge our financial risk, sorry, currency risk and interest rate risk? In my AFM lectures I have covered. What are they? Future contract, forward, money market, swap, options, right? Future, options, swap, these are some hedging instrument. So they are known as hedging instrument. And hedged item, what is hedged item? The item that you want to hedge. For example, if you want to hedge your currency risk, because your foreign exchange risk goes up and down, it changes, no, currency changes. Because of that, you are exposed to foreign exchange risk. So you are going in a forward contract to buy this much of currency, fixed currency. So that currency is your hedged item, and hedging instrument is that contract. What is the contract? The forward contract, future contract, option, whatever it is. So in this case, what is the hedged item? If you see derivative aids, oil. Oil is the hedged item, and hedging instrument is that future contract or forward contract. Let me see, what is it? I think it's a future contract. Yes, it's a future contract, and the hedged item is the oil. There should be some relationship between that forward contract and that oil. If it is there, yes, you can say hedge effectiveness. That means your hedge is effective. You can effectively hedge. That is the meaning of hedge effectiveness. Second, effect of credit risk does not dominate the value change that arise from that relationship. What does it mean? Second point, effect of credit risk does not dominate the value changes that arise from that relationship. See, your hedged item or your hedging instrument. For example, for hedged item, we'll take oil. You want to hedge your oil price. And hedging instrument, let's take future. For example, I'm taking, this could be anything, okay? So if the value changes, okay, in the future or in the oil, that changes in value is because of that relationship. That should arise from that relationship. For example, if one increases in the future, if you're having a profit, okay, you must be incurring a loss in the hedged item. That is your oil price went down, maybe there you are incurring a loss. That's why you went opened up a contract, and there you are getting a profit. Understood? So that because of that relationship, okay, you are offsetting, you are able to offset your loss. You're having a profit somewhere and you're having a loss somewhere, okay? But if your oil price, let's say your oil price went down, see, both of them are related on each other, okay? If value of one item changes, it will have an impact. For example, if you are incurring a loss because oil price went down, you are going to have a profit in the future. But understand why you are having a profit in the future: because of a loss in the oil. If you are not having that loss, you will not incur a profit in the future. Understood? Because of that loss. So this profit that they are incurring is because of this relationship, two-way relationship. It's because of this relationship that they are having among each other. There is an economic relationship in the first point we covered. Because of that, they are having this profit and loss. Because of that, they are having this value that they are having. Value of this future or value of the oil. Understood? That's why the value changes. Value changes in one will have an impact on the other. But if any of it, whether oil, whether the hedged item or the hedging instrument, the value changes because of the credit risk, then it is not a hedged item. Then it will not meet the criteria for hedge effectiveness. You cannot say your hedge will be effective. Okay? You cannot say your hedge will be effective. That is the meaning of effect of credit risk does not dominate the value change. That means your credit risk should not change the value of this, either this or that. That should not dominate. That should not be the sole reason for the changes in value. If the value changes because of that relationship, yes, it is one of the criteria. It should not be of the credit risk, not because of the credit risk that the value is changing. Because sometimes when the value changes is because of the credit risk, then it does not meet the hedge effectiveness criteria, remember, because they told does not dominate. Understood? Credit risk should not dominate the value changes that arises from that relationship. Maybe with an example and numbers you'll be able to understand this better. Third point, hedged ratio should be the same as that resulting from the quantity. See, everything is hedged. It's very confusing. Everywhere you see is hedge, too much of hedge. Okay, sometimes I also get confused. Okay, anyway, the hedged ratio should be the same as that resulting from the quantity of the hedged item that the entity actually hedges and the quantity of the hedging instrument that the entity actually uses. What does it mean? Quantity of the hedged item, that is the oil that you are hedging, okay, that the entity actually hedges, actually how much oil they're hedging versus and the quantity of hedging instrument. What is the quantity of the hedging instrument that the entity actually uses? For example, 5 contracts, 6 contracts, how many? So that ratio should be same. What is the ratio? This is hedged item. This is hedging instrument. It should be 1:1. It should be same. If it's 2:1, it does not meet the hedge effectiveness criteria. It should be same. That is the meaning of it. Hedge ratio. 1:1, 2:2, 3:2. It will always be like that. Okay. So too much of numbers and too much of this thing will not be asked from this area. If you just know this hedge effectiveness criteria, that much is enough for you. This much is enough for you. More than this, they will not go, and they will not ask you also. So you don't need to worry at all that what if they give numbers and how do I do this? They will not do that. Because to test your IFRS 9 knowledge based on number, they have so many other things in that standard. So this they will leave it. This they will make it easy for you. Okay, only the knowledge part you need, writing part. Calculation they will not ask from hedge effectiveness area. Even in a textbook you see there, I don't think there are any calculations or to find ratios or anything like that. So this three, okay. Again, I will summarize what I have just told. First one, relationship has to be there between hedged item and hedging instrument. That is oil and future. Second, value, if value changes in oil or value changes in credit, the hedging instrument, that is future, that is not because of credit risk. The value in the market changed, oil became, the risk increased, or in the market, the value of the oil fell down. That's why no, because of the relationship. Third, ratio should be same. Hedged item quantity versus hedging instrument that they actually use. Now, IFRS 9 says that the assessment of the effectiveness must be forward looking. When you're assessing the effectiveness, they must be forward looking. Okay, so this is exactly from this one. Now we are moving towards the derivative. Derivative A, B, and C. Derivative is very easy. Do not get a shock when you see this in your exam. Derivative is something which is very easy. Do not take it in a complicated manner. Okay, why? Because derivatives are measured at fair value. All derivatives have to be initially recognized at fair value. Subsequent measurement will go to that later, but initially everything is at fair value. Not like your financial instrument or debt instrument, that is amortized cost or OCI or fair value to profit and loss. Nothing like that. Derivatives all at fair value initially. So at the consideration given or received at inception of the contract. Okay, what is that fair value? Whatever the consideration that is given or that is received at the start of the contract, that you can take it as a fair value. You recognize a derivative at that amount. So in case of derivative A and C appears to have no purchase price, so they are initially recognized at nil. See how they are putting it together rather than repeating every time. Derivative A, no purchase price. Derivative C, no purchase price. They are not repeating and wasting time. Together you can write like this and save time, because you need to type also, no? So don't duplicate. Wherever you can take things together, common things are there, put together and write. Type. You see here again, initial recognition at fair value nil, nil. Both are nil. So initially it will be at nil. Okay. Derivative B. What about derivative B? It will be initially recognized at its fair value of 1 million. For initial measurement, you don't have to read the details. 1 million is given. Now we are moving towards, that's 20 million. Okay. Derivative A we can answer because we have read about it. Derivative B and C will come to that later. Okay. It's 20 million, which is liability. They have recognized, right? They have entered into this derivative for what purpose? Either for hedging or for speculative. Out of these two reasons, you can enter into derivative. My AFM students will know this better, right? So they have given for speculative purpose. How do you know it's speculative purpose? See, they believe oil prices are due to rise. This is something which is speculative. When you are betting that prices will rise, through which you can earn. Okay, so your motive is not to hedge due to some risk and all. Your motive is for speculation purpose. You want to earn profit. Okay. So here they have entered into for speculative IFRS 9. What does they say? All derivatives not designated as a part of a hedge accounting arrangement are accounted for at a fair value through profit and loss. See, if it is the derivatives are designated as a part of hedge accounting arrangement. How do you know a hedge accounting arrangement? When you want to hedge, when your purpose is for hedging, then that derivative will come into the part of hedge accounting arrangement, remember. But this is for speculative purpose. So this derivative, okay, if it's for hedging, fair value through profit and loss. I'm sorry. All derivatives not designated as a part of hedge. Not designated means out of hedging. This is for speculative. Then it will be at fair value through profit and loss. So this will be at fair value through profit and loss. So the loss of 20 million, immediately you have to recognize in profit and loss. So debit profit and loss and credit derivative 20 million. Okay, that's what you have to do. This is the accounting entries you should know for derivative. Okay, liability 20 million. Where do you credit? You credit in the derivative account, and you debit profit and loss. It's a loss. Come into derivative B. Okay, derivative B we have more definitely, but we need to read for derivative B. There has an investment in equity designated to be measured at fair value through OCI. Investment in equity. This is a separate, okay, investment in equity. That one was just a derivative. So they are concerned that investment will fall in value and wishes to cover this risk. What is the idea here? Main motive is to hedge. You can see they are concerned that value will fall and they want to wish to cover this risk. Thus, during the year, they entered into derivative B to cover any fall in value and designated this as a hedging instrument. See, when something is designated as a hedging instrument, they will specifically tell you that. They will not lead you to confusion that you should decide on your own whether it will designate it or not. They will tell you like this one. So designated as a hedging instrument is a part of a fair value hedge. Remember, hedge could be two types. One is fair value, one is cash flow hedge. Okay. Part C is a cash flow hedge. Both the hedges I have covered. I think fair value hedge was in my part 9 of IFRS 9, and part 10, the last video on IFRS 9 was on cash flow hedge. According to my memory that I can recall. The thing is, I have uploaded so much of video that I actually cannot, recall the number that this is this. But yes, it is somewhere towards the very end. Fair value and cash flow hedge. Okay, and they're different also. There are similarities, there are differences also. Difference is very small, so it's don't panic so much by looking at this word. Okay, if you're panicking means you're not prepared enough. This is the way to test yourself. How do you know whether you are prepared? If you're very confident, that means you are prepared very well. If you're not confident, you will know it when you sit. Even in your home also, when you sit to write this paper, you will, through your confidence, you will understand. You can analyze yourself. So if you're not confident, prepare more. Go back, prepare more, take more time, take more notes. Okay. So in fact, because this is fall in value regarding fair value and nil. Okay, so fair value hedge. In fact, by the reporting date, the asset increased in value by 8.5 million. 8.5 million, the value increased. It's the other way around. So for that, if it's a fair value hedge is effective, then the movement in the fair value of the item and instrument since the inception of the hedge are normally recognized in profit and loss. Okay, because fair value, okay, normally it is recognized at profit and loss. Okay, normally. But in this case, if the hedged item is investment in shares, for investment in shares it is OCI, and they have told also hedged item that has been designated to be measured at fair value through OCI. They have designated it, right? That it will go through FVOCI. Then the fair value movement will go in the OCI. Simple as that. Fair value movement for both hedged item and hedging instrument. Don't forget, there are two things now, not just hedge. One is hedged item, one is hedging instrument. In this case, what is the hedged item? Hedging instrument is the derivative, and hedged item is what is the item? That is the equity instrument, the fair value of equity instrument. That fair value is the hedged item. Okay, equity investment. So Just give me a minute. It is 9 million and one. Okay, 9 million liability and 8.5. Okay. So, and they have been designated to be measured at this. Okay, in your case study. Now, write the entries. Debit where? Where do you debit? Remember, investment in equity is a financial asset. Financial asset could be of two types: debt instrument, equity instrument. Equity instruments means investment in an entity or something like that. Investment in share, that is. So this is a financial asset. You debit 8.5 financial asset. And where do you credit? Other comprehensive income. Other comprehensive income you credit. And you debit what? 10 million comprehensive income and you credit derivative 10 billion. Remember, whenever you're writing this, your debit should equal to your credit. Just add up your debit. 10 plus 8.5, 18.5, and credit 8.5 plus 10, it's 18.5. How it is 10? If I ask you this question, why? Because the value went up. That's why you're debiting financial asset 8.5, and it's a gain. Gain will go on other comprehensive income 8.5. We know the first part. This part we know. What about the next part? How it is 10? See. Okay. Fair value. Okay. Just check. Fair value at the year end, it is a 9 million liability. Okay. But at the reporting date, asset increased by 8.5. Okay. Wait. Wait. We'll check for derivative A how 20 million they have recognized. Incurred a loss. So you debit 20 and you credit that derivative. Okay. See, when you are taking this 10, just you are crediting here, but there's a loss in the other comprehensive income. That's why there's debit of 10. So 10 minus 8.5, just check the difference as 1.5, no? 1.5. Same for derivative also. You're crediting by 10. Okay. So we need to check this. Because it's a line 9. Okay. So initially you recognize at 1 derivative. And the value went, wait. But how it's 10? That's our question. Because we know asset increase, so fair value debit and your other comprehensive income also you are debiting it. But definitely in your other comprehensive income there might be a loss. That's a doubt zone which I'm having. That why is it 10? Any fair value movement will go, both will go in the OCI. Okay. Initially, you are recognizing it at fair value. Okay. That means you are taking the total of 1 and 9. Because if you take 1 and 9, this is how you're going to get 10. Okay, just after this investment, any equity measured at levels where the comprehensive income. So initially, they are going to recognize this 1 million. Just go to initial recognition for derivative B. Initially, you are going to recognize 1 million, right? So initially, it will be 1. Credit derivative, right? You are going to credit derivative initially 1 and then liability at the year end is 9. So that means 1 plus 9, it will be 10. And from 10, that's why you are crediting derivative 10. And you are debiting your OCI also by 10. It's a loss. You are taking that out. And you are crediting. So if you make other comprehensive income, 10 minus 8.5, it should be 1.5, the gain that you're having. Because from your other comprehensive income 10 at the year end, you are having a gain of 8.5. So this gain you have to take out from this loss 10. Okay. So earlier it was debited 10, now you are crediting other comprehensive income 8.5. Okay. And derivative will be 10 because 1 plus 9. Now, derivative C. If, okay, derivative C we have to read. They are concerned about the potential for raw material prices to rise. It manages this by entering into derivatives of future contract. This arrangement has been designated as a cash flow hedge. At the year end, the prices have risen. Okay, they are expecting it to rise and it rised also, giving the company an increased future cost of 24 million. 25 million is an asset. You see, this is an asset that they have recognized. And this is, by the way, this derivative is 10 million contract because at the end it's 9 million, right? It's given here. That means 1 minus 10 will give you minus 9. Okay, to get at the year end 9, it should be 10 from the initial. That's why derivative is credit 10 million. Because in order to get this 9 million liability at the year end, you have to credit this derivative 10. That's how you're getting it. And from OCI also, it will be a loss. Okay, because from 1 million, it went to 9 million liability. So it's a loss. So that means in OCI, you have recognized a 10 million loss. That's how you are getting it. Because it's 1 and this is question mark which you have to find out, and this is minus 9 because it's a liability. So it has to be 10. Okay, that's how we are getting it. In other words, 1 minus 10 is minus 9. Like in this case, it's nil and then asset. Okay. If this is effective, movement in the fair value is accounted for through. If it's for cash flow, then the fair value movement will go through other comprehensive income. That is the difference. If you check in part derivative B, any changes in fair value will go through profit and loss. Right? Unless it is designated through OCI, like in derivative B. But in this case, no designation, it will go through other comprehensive income only. Because there's a cash flow hedge and if any changes in the fair value. However, if the movement on the instrument exceeds the movement on the item, Moment on the instrument, that is your hedging instrument. Your derivative exists the moment on the item. Excess is recognized in profit and loss. This is the difference between cash flow and fair value. Okay, in derivative cash flow hedge, we'll be having excess that is recognized in profit and loss. But here everything, no excess, nothing. Fair value, either OCI or profit and loss. Normally profit and loss, but if designated through OCI, then yes. But derivative C, no. No designation, OCI only, but excess will go to profit and loss. Now, this is how the following entry is. Because of the year end, it's debit. So debit derivative 25 million. It's an asset at the year end, and other components of income because it's a gain. See here. Any changes, you have to recognize it in OCI. You see, increase the future cost of 24 million. Okay. This is a derivative, and this is hedged item. And what did they say? Read again. Moment in the instrument exists the moment on the item. So moment on the instrument is 25 and this item is 24. If this exists, the excess is recognized in profit and loss. That means 25 minus 24. What is the difference? 1. Only this one is recognized in profit and loss. But 24 will be recognized in OCI. Credit is a gain. Only 1 million loss. Okay. Sorry, it's not a loss, but it's an excess that is recognized. Credit. It's a gain. Okay. Just will check again. Increase the future cost of 24 million. So don't look at the word increase future cost or something. We have to check in the fair value. Okay, fair value increase means future cost also will increase, but we have to check in the fair value. So because of that, debit derivative, credit and credit P&L. When raw materials are purchased, gains recognized in OCI then will be reclassified against the carrying amount of the inventory. When you're finally purchasing that raw material, okay, whatever the gain now you're recognizing in OCI will be carried against the carrying amount of the inventory. What does it mean? IS2 will apply. Inventory. You're buying it, no? It's a raw material. It's an inventory. So this will be reclassified against the carrying amount of the inventory. That means you are going to deduct this against the carrying amount of the inventory. Okay. Because you are going to debit other comprehensive income 24 million and your credit inventory. Credit means your inventory will go down. Understood? Now we are coming to the third one, overseas loan. This should be something easy actually, in fact. Which standard? IS 21. And I can see IFRS 9 is also applied, but not so much. Maybe it's something to do with financial liability or something. That's why IFRS 9 comes. Their function consists dollar. Artwright took a foreign currency loan of 5 million dinar at a fixed interest rate of 8% on 1st of May 2003. Okay, effective rate is 8%. Annual interest payment amounts on 30th April 2004. The loan will be repaid on 30th April 2005. That is after 2 years. Okay. Currency rate as given. First and this one. Average rate is also given. Average currency rate is not materially different from the actual rate. That means wherever you have to use actual, you can use average rate because it is not materially different. And the directors require advice. One is on loan, one is on interest. So 4 marks each. That's why you're going to get the 8 marks. Okay. And what type of loan is this? Foreign currency loan. It's a financial liability. Financial liability. So IFRS 9 rule also needs to be applied. Now, so this loan is a financial liability. Immediately you need to identify that. Why? Because through that you are going to receive. You have an obligation to pay cash. That's why. Financial liability because it contrasts a contractual obligation to transfer cash. You see, just saying financial liability not enough. You have to give reasons. Reasons is you have an obligation to transfer cash. So in accordance with IFRS 9, okay, what does it say? Most of the financial liabilities are measured at amortized cost. Okay, remember that most of it are measured at amortized cost unless you are selling it before the time period. Then you are using other measurement model. But this you are keeping it, okay, I think for 2 years, so amortized cost. So when it is liabilities at amortized cost, use your knowledge of IFRS 9. You need it. Looking at exchange rate, don't think you don't need IFRS 9. Only IAS 21 will do. Just I will convert and no. Liabilities amortized cost should be initially recognized at fair value less transaction cost. Less transaction cost, this is liability. If it's an asset, it's a different thing. So the finance cost is calculated how? Using effective rate of interest and charge to P&L. It's an expense. Okay. So now, remember this loan is denominated in what currency? Overseas currency. So you have to translate it using the rules of IAS 21. Okay, you have to convert it into the functional currency. So this overseas loan should be initially be translated into the functional currency using historic spot rate. And what about the finance cost? The interest? Translated at average rate. Remember, finance cost is an expense. All the items, income and expenses that goes in profit and loss are translated at average rate, and all the statement of financial position. For example, loan depends on the day you have taken the loan. So historic spot rate you have to take. They will be translated using two different rates: amount of loan versus interest. Okay. The cash payment should be translated at historic spot rate because the payment occurs at the reporting date, it is at the year end. And a loan is a monetary liability. Remember what kind of item a loan is. When a standard and IAS 21 is given to you together like this, you need to identify that particular item. Like in this case, what is that loan? It's a monetary liability. Is it non-monetary or monetary? If it's non-monetary, some other rates. If it's monetary, some other rate will be applicable. That's why you need to identify the difference. This is a monetary liability because you have to pay in cash. So it is retranslated at the reporting date using the closing rate. Remember, retranslated. We are talking about translation part is over. But at the reporting date, when you have to retranslate, closing rate, because there's a monetary liability. All monetary assets and liabilities. Monetary assets also closing rate. In fact, I think most of the items in the statement of financial position is at closing date. The monetary items. And any exchange gain or loss is recognizing profit and loss. Don't forget about the exchange gain or loss, because when you're translating, you'll be incurring some exchange gain or loss, which goes in profit and loss. Okay. Because sometimes what happens, they might go to OCI also. In this case, it is profit and loss. Because you are measuring it amortized cost. What is it? Amortized cost. Liabilities are measured at amortized cost. If it was liabilities at OCI, then okay. But if it's amortized cost or fair value through profit and loss, then exchange gain or loss goes in profit and loss only. Now calculation. Calculate. So for calculation, use Excel. Use 4 columns like this. Description in one column, then dinner, the rate, dollar million. Use 3 columns like this, rather than just calculating this number. No, or this number. It's not enough. In your calculate, you will calculate and only put this number in your word. Not enough. You need to show this, this, like this. Very recently, I got an email from someone asking me whether they have to show formulas and all, or whether just writing answer will give you marks. No, you have to show formula. How to show formula? Just put the number like this, and in this cell, when you are doing calculation, automatically you don't have to show 5 into 5. In an Excel, when you're doing the calculation, automatically when someone clicks that cell in the formula above, they can see the functions that you have performed. For example, you divided this 5 divided by 5. So you don't have to show 5 divided by 5 in the cell, and then you have to put another cell 1. It's not needed. Automatically, when you are doing this, what are you putting here? Equal to this, let's say A1, this is B1, sorry, B1 divided by C1. This cell is B1, this cell is C1. So you will click on this cell and you will click divide by this cell when you go to this cell. So automatically it will give you answer. Just press enter, it will give you the answer. And you can just drag it down to the other cells like this. So when someone clicks that cell on the top, they will be able to see the function. That means some calculation you have performed rather than you just typing, you keeping 5 and 1 and you just typing 1 here. It should not be like that. Someone, when they click that cell, they should be able to see the formula above the function that you have performed. For example, 5 divided by 5 in Excel. Like that, you have to show the formula. Okay, I'm not telling you, okay, for example, if it's just that formula. For example, for goodwill, you're not writing goodwill is purchase consideration plus NCI, then net assets, fair value of net asset minus. You're not writing like this. But in the number, when you're doing 20, 30, 10, automatically, when you are finding this goodwill, you are taking the help of this three cells. So in the goodwill, this cell, when you click, this numbers will be shown that you have added these two numbers and deducted it. Understood? That's how you're showing the formula. So now we are coming, start from the 1st of May 2003. Okay, we'll start with the rate. What is it? 5 million dinar. They told 5 million and opening is 5 at that date. 5, 6 and 5.6, just remember. So 5 million, take the rate 5 and 1. 5 divided by 5. Interest is 8%. Effective interest rate you have to take, by the way. Okay, because there is one more interest. Let me check. Students often get confused. That is that fixed interest rate of 8%. Okay, so in this case both are same. Okay, sometimes they give you a coupon interest rate, sometimes they give you an effective interest rate. They both are different. Okay, their purpose is different, so you have to pay attention to it. So 4% on that 5. This is the interest. Take this rate. Which rate are you taking? Average rate. So 0.4 divided by what? 5.6. Okay, so automatically when you perform the function in this cell 1, you can just drag it down, it will give it, except this cell you cannot drag it. This foreign exchange is a balancing figure, here you cannot drag. Okay, so let us go to the payment now. What is the payment? 5 minus no, sorry, payment is 0.4. How are you getting it? How are you getting the payment? Okay, we'll go to the payment section. Fixed interest rate. Okay, at 8%, and effective rate of interest on the loan is also 8%. So in this case both are 8%, but normally it's not so. Okay, so in this case again 8%, that is your payment. Okay, so payment also 8%, that's why it is 0.4 deducted, because that payment, you are making a payment from that amount of loan, fixed payment, so minus 0.4. And which rate are you using? The closing rate. Okay, because at the end of the year only you will be paying, so take it. For exchange, this is a gain. Okay, it's a balancing figure, we'll come to that later. Last figure is given to you. How? See, 5 plus 0.4 minus 0.4. So plus and minus goes and 5 is remaining, and closing, this time closing this date, and then translate. So when you go like this, 1 plus 0.071 minus 0.067, okay, this figure will be different to this. You are not getting exactly this figure, 0.83. See, when you do your calculations horizontally and vertically, you should be getting the same figure. That is the goal. You should. You are not getting. So that difference is here. It could be your gain, it could be your loss. Okay, so that difference is your gain or loss. How do you know whether it's a gain or a loss? Another question. How do you know whether it's a gain or a loss? Tell me. Always understand what is it. Asset or a liability. Very important to know whether it's an asset or a liability. Based on that, this is a liability. So you will always want your value of asset to go down at the year and not go up. If you take 1 plus 0.071 minus 0.067, it will give you 1 point. Do this calculation on your own and check 1.004, which is more than 0.0833. That means value went down of the liability, which is good. So this is a foreign exchange gain. In other words, if you're getting something in bracket here, a negative figure, it's a gain. It's a gain. But don't go by that negative and positive with bracket and without bracket. The best way is, this is a liability, you want your value to go down at the year end. So if the value goes down, it's a foreign exchange gain. If this was an asset, this will be a loss. It will be the other way. This will be a loss if it's an asset. Okay, that's why I tell you, don't go by the bracket. Check whether it's an asset or a liability. This is a loan, it's a liability. Okay, so it's a gain. Now you see marking scheme 1 mark per point. Okay, so initially you will record at 1 million the loan. How? Which amount are you taking? Now let me rub all this. Wait, this is very confusing. I will rub all these things. See, we are talking only about this 1 million. 1 million now in dollar. Initially you will record the loan at this million. At the end you have to write this description, by the way. You are getting marks here. Okay, doing this calculation is not enough, will not give you marks if you are not able to write it. Then finance cost, that is the interest, will be this much. This is also in million, million. You have to write it like this. Where are you going to write it? In the profit and loss account. Which interest cost? 0.07. While the cash payment, that means from the liability you are doing a cash payment, it is recorded at this amount. And foreign exchange gain is this much. This will be recorded where? In this case, profit and loss. That is the balancing figure. And the liability at the reporting date had a carrying amount of this much. What is it? This liability. This is the carrying amount. So step by step you have to write it also. Okay, so that's it for this question, and see you in the last question from your SBR revision kit. There are questions under your UK gap focus. I'm not covering those questions because that is for the UK syllabus. SBR for the students who are doing the UK syllabus, UK version of SBR. We don't need it. We are doing the international version, so we don't need those questions. No need to attempt those questions. You only have to do from question 1 to 56 in your revision kit, Kaplan revision kit. I don't know the way the questions are numbered in your BPP revision kit, but Kaplan, yes, 1 to 56 if you're having the latest revision kit. That is still your June 2022 exam. So guys, see you in the next question, the last question. Until then, take care.